Welcome to Swimming with Alligators
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
On today's episode, we have Anthony Jambroni. He's a partner at StepStone Group, and he was with Greenspring Associates, where he helped scale the platform from 5 to 85 plus investment professionals. Prior experience includes growth equity and investment banking. Today we'll be talking about lessons from scaling a lead venture allocation platform, also why relationships and long-term thinking matter more than ever in VC, and how emerging managers can stand out in such a crowded market. So with that, we welcome Anthony.
Thanks, Ernest. Really happy to be here.
Glad to have you. I know what, looking at your bio from the website, definitely impressive. But what really stuck out to me when we originally spoke on a prep call was you had the standard background of starting as a gas station manager. So I would love to just kind of hear how you got from there to all the other points that I mentioned in the bio.
Yeah, I come from a pretty modest upbringing. Might be the most unpedigreed guest that you've ever hosted. So, I was born and raised in Morgantown, West Virginia, which is where West Virginia University is based. Attended undergrad there, studied finance. Had the ultimate aspirations to be an investment banker, but was graduating in 2009, obviously at the trough of the GFC, and West Virginia's, not necessarily a target school. So I had to shelf that dream for a little bit. I had an opportunity to work with some real estate developers locally that were family friends, and they were starting a new project that was going to be like an interstate exit. That they were doing a bunch of different stuff, and instead of bringing in like a national or regional franchise to do the fuel and food, they wanted to develop a concept themselves. And they kind of just asked me, is it something that I thought I could figure out? So they handed me a building that was four walls, and basically said, go figure it out. And so I did that for like 2 years and helped them kind of establish that business, but kind of realized along the way that probably wasn't going to be my career. I was about to turn 25, and the markets were maybe getting a little bit better, and so I said it's kind of now or never. So I moved to Charlotte, North Carolina. I didn't have a job, but ultimately picked Charlotte because the West Virginia network is very strong there, and obviously there's a strong banking culture there, and cost of living was much lower than New York. To help pay the bills when I was in Charlotte, I actually had a night weekend job. I was at a nightclub, so that was another one for the resume. But I was eventually able to network and got in front of an investment bank called McCall Partners. And I became a part-time receptionist, and that was how I broke into investment banking. And in the span of 6 months, went from receptionist to intern analyst to then a full-time analyst, and then spent 2 years basically doing the traditional investment banking program. And in that journey, realized I was really passionate about tech and innovation. And started to learn about growth equity, which as an asset class going back to like 2014, it was much smaller than it is today, but that became a good go between venture and traditional private equity. And that took me to Salt Lake City, where I worked for a fund called Mercado Partners, and spent 2.5 years in that role before Greenspring brought me back to the East Coast.
Man, I love starting behind the front desk. Do you feel like having had every role has helped you manage all of these people? At this point, you're running a huge team.
I think it's been hugely important. It has always kept me grounded and very humble. We would say venture has always been and probably always will be a very relationship-driven asset class. We think EQ matters a ton. And I think just having the empathy to be dealing with people at various levels at different stages of their career, it's been very portable from all of those different roles to ultimately working in venture. Something I would say has been super, super important, at least as I built a foundation for my career.
Yeah, there's sort of two interesting approaches to getting into this industry. One is you sort of make yourself the boss and you start small. And one is that you sort of go the apprentice base, but then you work your way up. And I opted for the second, and it's never going to be less embarrassing to start at the bottom. And it was my logic. It's like just start answering the phones, to get in the door, and start seeing how the sausage gets made, was definitely my approach too.
Yeah. No, it's been super rewarding. I mean, I've had the opportunity to transition from someone that was just an individual contributor as a banker, and then obviously as an investor at what was a single strategy firm, and became a part of Greenspring when the firm was 45 people in total, and probably mid to single high digits in billions in AUM, and now have kind of seen all of that growth over the past 8 years, and it's been really rewarding to kind of get to build the plane as we were flying it, and have really enjoyed just all of the managerial exposure and opportunities to refine and optimize what we were doing from a people, process, and technology perspective along the way.
And to that point of being exposed to kind of the growth of Greenspring now into StepStone, what from those experiences have empowered you in this now kind of even more hectic environment for allocators, right? It seems like over that period of time, a lot changed in venture if you were allocating into venture from that period of growth for Greenspring, and how do you apply it to today's environment?
I mean, I would say we're generally always optimistic about the asset class. I think the advantage of being in a really large platform like ours is that also has multiple different products, is certain opportunity sets become more interesting, depending on maybe what's happening from a macro perspective. So when I started at Greenspring, the direct and secondary practice was much smaller than it is today. We were really, and that was kind of why Greenspring was recruiting me. They wanted to scale some of what they were doing at the growth stage, on both a direct, primary, and secondary basis. So I kind of got to be a part of that, and that was a really successful part of what we were doing, as part of the tail end of the bull market. And the secondaries fund, I would say it's actually proven to be pretty all weather for us. Like we've seen that whole practice grow from an $85 million proof of concept fund to now something that's a few $1 billion. And as everybody knows, like there's not a ton of liquidity flowing into the venture asset class. So, us having an all weather strategy that can pursue investments on cap tables, doing things, alongside our GPs.
Do you mind just giving us a lay of the land of what StepStone's venture practice looks like?
Yeah, today we're about 130 people. We're now 90 people exclusively focused on investments and research. So, as a platform, think we're probably one of the larger groups in VC. We're probably managing somewhere around 25 billion in AUM. We do that, out of kind of the core office in Baltimore, but have since built out teams in the StepStone offices that were focused on venture and growth in La Jolla as well as New York, but also have a presence in London, and across Asia as well. So, I mean, we're really a global organization, and we're doing everything through this fully integrated platform that does funds, directs, and secondaries. And as I mentioned maybe earlier, like pre-seed to pre-IPO. So we kind of get to see and do a lot, which makes things really fun and interesting.
With so many different types of products that you all invest in, and strategies, how do you all leverage when is the right time? I guess the collective knowledge of the team. How do you best leverage that so teams are working together to understand, hey, this is probably the best time in this type of product or this type of vertical or this region to invest in secondaries versus directs?
I would say the most important thing we've probably seen over time, and this is very pertinent for early stage, is that it's probably impossible to time the venture market. we would say you really need to have a strategy if you're allocating to early stage VC where you're doing that incredibly consistently. You don't want to pile in, when the markets are really frothy and then be pulling back when the markets seem to have reset. So, we would say the recipe for success in early stage is basically to always be doing it, but being measured in your approach and very thoughtful in how you may allocate. And a lot of that's just because venture returns are tied a lot more to innovation cycles and the innovation waves. They can be certainly supercharged by what's happening from a macro perspective too. This was definitely the case in 10, 11, and 12, where you had kind of the post GFC reset, but you also had the mobile and social wave. Our advice to people is, especially in early stage, basically figure out how to always be doing it. And then you may tactically allocate to growth stage directs or secondaries, but I mean, we're never really trying to time the market. And that's, I think that's a really important thing about our approach.
Addressing vintage volatility sounds like one way you do it. In terms of your allocation strategy, I've heard you say it's about 100 companies generate 50% of exit value over the past decade. And anything else you can share about how your strategy sort of tries to address this unique element of venture?
I mean, it's probably the consistency piece. So, we've looked at analysis that has told us that over the past 20 years, it's probably been 5 to 7 vintages that created 80% of the outperformance. I mean, that's kind of a really interesting stat that we think reinforces that message on being consistent, because you don't know if you're coming into the best vintage or the worst vintage, but if you are consistent over time and you are getting upper quartile exposure through your relationships, you should be rewarded for that. But specifically on the companies, I mean, I think the power law everybody understands. I think it's getting more acute because the outcomes for certain companies are getting even bigger and are having even more impact on vintage level performance too. So yeah, I mean, as you mentioned, like we saw data and it's basically saying there's been 100 companies that have generated almost 50% of the exit value. And if you look at companies that are still private today, it's probably 15% of active unicorns that are 60% of that collective private market cap.
You mentioned overall that your team generally has been optimistic about venture, and that says a lot because given, with the consistency that makes sense, but also understanding there's going to be some tight periods, and we're in one for most of the market. What actually has you all excited about the venture asset class today?
Yeah, I mean, I would say the two opportunity sets we're really excited about right now. One would be early stage, pre-seed, Series A. There's just so much interesting stuff being built. The ambition of entrepreneurs is really high right now. We're seeing that in categories that are further out on the risk curve. So aerospace and defense, energy, chips, obviously AI and ML. Just so many interesting companies being built that are very high risk, high reward. And if you're doing venture, I mean, that's what you're playing for. So, I think we're inspired by the ambition of the entrepreneurs. That gets us really excited about what's happening in early stage. And at the same time, kind of the other end of the barbell is what's happening in the secondary market. There's probably over $1 trillion of unrealized NAV in the venture asset class. I think we're maybe optimistic here today, but the windows sometimes close as fast as they open, so we don't ultimately know. But as we look forward over the next decade plus, we do think there's going to have to be new and creative ways to solve the DPI and distribution dynamics in the venture asset class. I think we'll hopefully have an opportunity to do that, but we certainly won't be doing that ourselves.
When there's more like ambition from founders and they're trying things that are further out in the risk curve, how has that adjusted your diligence of fund managers as well as founders themselves?
I mean, I think one of the things that we fundamentally believe is, there is a lot of preferential attachment in venture, and there is going to be a group of GPs that are going to attract the opportunities to work with the best founders. And, there's a lot of self-reinforcing dynamics within that. If a GP has been successful taking other companies to big exits or outcomes, it's just the fact that other entrepreneurs want to work with those same GPs. So, I think for us, it's identifying who are those people that we think can win in the marketplace, and that can ultimately be partnering with who are going to be the generational defining entrepreneurs. And a lot of what we're doing is trying to assess that at a given time. Some of those people may be sitting, still in traditional venture funds, but, increasingly we're seeing some of those people maybe leave the platforms or the firms that they helped build and are now spinning out as kind of emerging managers, albeit very experienced. But, those are stories that we get really excited about.
And I'm curious, when you do think about sort of your emerging manager strategy, is it focused then on the spinouts, or is there another sort of bucket or category of emerging manager that's also interesting to you?
I mean, I would say that has been the category that we historically have spent the most time on. I think one of the benefits to what we're doing is we have so much information and data on all of the underlying assets and underlying companies, having a really deep view on track records for all of these GPs across all of these different funds. So it kind of gives us a prepared mind. Like when we know someone is going to be spinning out from a firm, we probably have a view on what their track record looks like, and if that's a story that we would want to be a part of. And, the reality is some of these, even if they may be fund ones, for some of these spinouts, like the funds are very efficient in how they're being raised.
Any nuggets you can share, because you're looking across so many managers, on just insights you're seeing, or just sort of some like interesting things you've pulled out of that have informed your own thinking?
I mean, some of it would be what I was describing. I mean, I think you just have to have tremendous conviction that someone is going to be able to go into that marketplace that is a very competitive marketplace and win the hearts and minds of entrepreneurs. As I mentioned, like it's a really small number of companies that are going to drive disproportionate value. All of those entrepreneurs probably have the luxury of choice from which VCs they're going to take money from. And so how you show up and how you win in those scenarios, that's something that we think is super important. So whether that's a network edge or some ecosystem advantage, whether it's research, you really have to have some edge to be winning. And, it's not just enough to identify, like you do have to win that opportunity. And so if you're a solo GP or you're, spinning out and starting a fund, like you're going to be competing against some of the best brands in venture at seed and Series A. And so, how we kind of see people show up and how we see people win, that's really influential in how we underwrite.
Now we're going to take a quick break to speak with our sponsor.
Rebecca, you are specifically focused on employment issues at Sidley. What's an interesting problem you've been helping a VC or founder client with?
Frequently, we work with venture-backed companies navigating what I would call the co-founder divorce in the AI era. The scenario is like this. A company was founded by 2 or 3 people. Company has raised significant capital, and now one of the co-founders wants to leave, often to start something new in a related vertical. The legal and practical challenges of this are immense. You have questions about IP ownership, about what the departing founder can and cannot take with them, about how to handle their equity, vested and unvested, about how to communicate the departure to investors and employees, how to protect the company's trade secrets when the departing founder's entire skill set is built on knowledge that they've developed at the company, right? So these situations require a blend of employment law, corporate governance, intellectual property, and frankly, diplomacy, right? The best outcomes happen when everyone comes to the table early with experienced counsel and structures a separation that protects the company while treating the departing founder fairly. The worst outcome happens when people lawyer up after their relationship has already deteriorated and the departing founder has already started building something on the side, which happens quite a bit. So my advice to GPs is always the same. If you sense a co-founder dynamic is fracturing, get involved early and bring in counsel who can help structure a clean separation, ideally before it becomes too adversarial.
Man, what a delicate period. Especially if you sort of have an agenda, right? Are there any mechanisms to sort of assist with a clawback or handling the equity of the departing founder in the benefit of the business?
Yeah, the answer a lot of times depends on what was negotiated up front, which is why the initial equity documentation is so critical. Frequently in this kind of ecosystem, nobody's focused on it at the upfront stage. And so we have to clean it up at some point, right? If the founders have implemented a vesting schedule with a repurchase right, then the unvested shares are typically repurchased by the company at cost on the founder's departure. Vested shares are a lot more complex. In some cases, the company or the remaining founders will have a right of first refusal or a call option on vested shares, often at fair market value. In other cases, the departing founder retains their vested equity, but is subject to transfer restrictions and drag-along obligations. The worst scenario, which we often see, unfortunately, is when founders split equity 50-50 at formation with no vesting, no repurchase rights, and no buy-sell provisions, because then a departing founder walks away with half the company and the remaining founder has no mechanism to recapture that equity. So this is one of the foundational issues that we urge every startup to address at incorporation and every VC to diligence heavily before investing.
Yeah. And given that it is so common to, this is a handshake, you're sort of going on this journey with somebody. Is there a kind of convenient time to renegotiate this? Are you stepping in at a big Series Seed or Series A where you might recognize that things have been split 50-50 without all these provisions you've described? I'm sort of thinking, how can we be proactive given that's what we're often faced with?
Yeah, anytime there is an investment happening or a deal adjacent event, particularly if there's a change in control, right? But even at the investment stages, that's a great time to clean up whatever issues have happened. And you can condition your investment on that cleanup and say, we need everyone to sign an invention assignment agreement. We need everyone to sign this equity vesting document. And it's going to talk about what has happened to date and what's going to happen going forward. And you make that a condition of your investment. And then that way you can make sure that the paper is correct going forward. Because a lot of times what happens is, especially in the tech world, you have young founders who are working on a problem with their friends in their house, in their parents' garage, right? These are the Silicon Valley stories you hear about. And they are not focused at that stage on writing everything down in a legal contract. And so when the investor comes in, that is where you can really add value right from the start is, I'm going to invest, but first you have to get your house in order.
That's brilliant. Curious, are there any other structural or legal innovations related to employment that are on the horizon that GPs and founders should be aware of?
There are a few worth watching. First, the continued evolution of worker classification law. California implemented an ABC test under a law called AB5 a number of years ago. There are similar frameworks in many other states that continue to create complexity for companies that rely on independent contractors, gig workers, or fractional talent, which for early stage companies is often the case, right? You're trying to stay lean. So understanding where the line is between an independent contractor and an employee is critical, particularly as you start to scale and scale fast. If you get it wrong, that can be significant in terms of the liability exposure. Pay transparency laws are also proliferating rapidly. California, New York, Colorado, there's a growing list of jurisdictions who now require companies to disclose salary ranges in job postings. And in some cases, you have to disclose that to your existing employees upon request. And so this has a cascading effect on things like compensation strategy, internal equity, and recruiting. So for venture-backed companies that have historically operated with informal compensation practices, this is a real wake-up call to professionalize your compensation infrastructure. And then lastly, everyone's talking about AI, right? And I am watching the intersection of AI and employment regulations very, very closely. Several jurisdictions are beginning to regulate the use of AI in hiring, in performance evaluations, in termination decisions. We also anticipate, although we have yet to see, potential federal regulation in this space. So for companies whose job is building or deploying AI tools that touch employment decisions, so on the back end of it, this is an area where the regulatory landscape is evolving quickly and compliance obligations are becoming more demanding. And if you are building those AI tools, your clients are going to expect you to be in front of the regulations on it so that they're not getting pass-through liability.
Yes. I had a friend reach out to me asking for a reference and then texted just a few minutes later and said, never mind, I don't need an in into that company. And he later explained he had officially applied online at like Sunday night at 7:30, and he had already been rejected by 7:45.
That actually, a very similar situation is the subject of a class action against Workday in California at the moment. And it's based on a very similar fact pattern. An individual
I'm more than happy to look in to see if it was a Workday email he received the rejection. Sounds like it could have been.
It's a new state of things, right? And employees are insisting on, and laws are allowing employees and prospective employees to insist on human review in many cases.
Yeah, absolutely. No, he was waiting. He had the reference call coming from me. I would have gladly done it. What would you like our audience to know about your firm, Sidley?
Sidley is a firm that takes the venture ecosystem seriously. This is not a marketing exercise. This is a core part of our practice. We have made deliberate investments in building teams that understand how venture-backed companies operate, how boards function, how cap tables work, and how the interests of founders, executives, and investors intersect. We understand that if you bring us an employment issue, it's not a standalone HR question. It sits inside of a broader corporate governance and commercial context, and we advise accordingly. Sidley's also a firm that shows up when it matters. The situations that keep GPs up at night, founder misconduct, a sensitive separation, a talent raid by a competitor, regulatory investigation. These are the situations where you need counsel who has seen the movie before and who can move quickly and with good judgment and get the playbook outlined, right? That's what we do. And we're proud of the relationships we have built with the venture community doing exactly that kind of work.
Oh, fabulous. Thank you, Rebecca.
And now back to our LP interview.
Any tips for our other allocators on how you diligence after hearing someone say, hey, systematically, here's my edge? Are there any tips and tricks on how you figure that out, if it's true?
I mean, there's always the element of art and science. I think prior success, at least in venture, has been something that has been somewhat indicative to at least the potential for future success. As I was describing preferential attachment, we think that the best entrepreneurs are often attracted to people that have been successful GPs in the past. So, that has been true in venture historically. But it's always a blend of kind of matching where a person or a GP may be at a point in time with the firm. Obviously, in the early days in Fund 1, it's going to look a lot different than it might look in Fund 3. And, you kind of have to have the belief that not only can they source and can they win and can they add value and can they drive these companies to successful outcomes, but can they build a firm and build an organization and a team around them as well.
And for helping emerging managers stand out, is there any common mistakes to avoid?
I think the biggest thing is just understanding, one, who is on the other side of the table. So like from an allocator perspective, what their program might look like. As a fund of funds, we're oftentimes very limited in the number of slots that we might have in a given cycle. So, we kind of have a manager roster. That roster probably stays fairly consistent, fund over fund. So if you look at seed, for example, you could be talking in the US 15 or 1600 funds. And in a given cycle for a new seed relationship, we may be down selecting to one or two. So, the down selection is really tight. So just very competitive to kind of find a slot within a fund of funds. We also have advisory relationships and SMAs that, we're able to partner with maybe some additional groups, but just the overall down selection for a group like us is really tight. And so I think just understanding that, at a given time, we may not have an opportunity to invest, or in a given cycle, we may not have an opportunity to invest, but we've been doing this for 25 years. Hopefully we're doing it for another couple decades.
Are you seeing across all the different managers surprises and kind of underweight strategies? Like, are there any strategies you wish you saw more of?
I mean, we've never really had a hard view on people that may be investing broadly versus people that may be specialist. I think the reality in ventures performance is probably, it's got to, like upper quartile performance has got to be absolute, can't be relative. So at the end of the day, like you have to believe that these GPs are going to be in the best companies, full stop. But we have partnered with some groups that are maybe more specialists, but think that within these specializations, they can build really big companies. And probably some of these people have done that in those categories from their prior roles. But there are certain segments, like the micro growth segment is a segment we're spending a lot of time on right now. That's an exciting category. A lot of people that have grown up in maybe second generation growth equity funds that are now spinning out to start smaller funds. And we're spending a lot of time there. So that's an opportunity set that we're kind of excited about, that really slots within the emerging manager landscape. It's just not kind of a traditional VC type underwriting.
No, given that you're trying to get into those 100 companies, that's probably the most clear and thoughtful answer we've seen to generalist versus specialist. That who cares what you are if you overlap with those huge winners. And we have so many LPs who are listening who don't have the kinds of data and 25 years of historical references. What's your advice to them on entering this asset class?
It's similar to how GPs might think about entrepreneurs, and having to have some mousetrap that enables you to get access to the best entrepreneurs. For LPs, I think you have to be really thoughtful. Do you believe that you can get upper quartile performance either directly, and if you can't do it directly, can you do that through partnerships? I would say we've seen interesting changes cycle over cycle. At the end of the last cycle, you saw more and more LPs going direct. I think now some LPs look at what, vintages 2021 might look like. I think they're now saying, hey, maybe it's better to have this partner approach, to do things through a more diversified set of vehicles, and to rely on, a group like StepStone that has 90 people exclusively focused on venture and exclusively focused on having relationships with anybody that might be in market, not just in the US, but kind of on a global basis. So, there's a lot of different ways to do it. I think you just have to feel really confident that you can capture the upper quartile. If you're not capturing the upper quartile in venture, then the risk and the liquidity probably make it not as compelling of a situation.
A quick question on just that, on that part, Anthony, because it's become, ventures in early stages become way more mainstream and more players have entered, even those from different asset classes. Is top quartile good enough anymore?
I mean, I think our view is that there used to be a very wide dispersion in returns if you went back, 20 years in venture. The bottom quartile meant you were probably losing a lot of money. The median, you were maybe breaking even, and the top quartile was probably 20 to 25%. As we went through the bull market cycle, you actually saw that the bottom quartile lifted up to basically zero, and the median was maybe 10%. So you had people participating in the bull market in what was the riskiest asset class, and you couldn't lose money. So, we think that the next evolution of venture probably is going to look more like what it looked like in the past, where there's going to be a wider distribution in returns. One of the things that we do think is true, though, is that some of the outcomes that you're seeing in venture are certainly bigger than I think what people have historically imagined. We're definitely seeing that in AI and ML with what's happened with the foundational model companies.
One thing that we talked about in kind of pre-conversation was how to really approach secondaries. And you brought up a good point that, on some recent research about how to think about discounts. Can you share that with our audience?
I mean, it's maybe a controversial view. In our practice of doing secondaries over 25 years, we've probably found that the discount matters a lot less than the underlying asset quality. In our secondary business, we're buying direct on the cap table of companies. It could be single LP interest. It could be maybe GP-led solutions. But, what we're always hunting for is really high concentrations of NAV into companies that we believe are going to be, those of consequence for the venture funds and ultimately for the venture vintages. So for us, it's been a lot more about pursuing absolute asset quality versus chasing discounts. We think in broadly diversified venture portfolios, there could be a lot of fool's gold. There could be stuff that, depending on valuation policies may look valuable, but you may find over time and at exit, those things could be less valuable. It's one of the benefits that we have of being like a really big primary investor is we have valuation viewpoints. We could have valuation viewpoints on one company 6 different ways across venture funds. So when we're looking at secondaries, we're also really leaning on that informational advantage that we have from our primary fund business.
You mentioned it, and we all know it's a relationship business, but now with more automation, I think and with everything that's happening in AI, the markets are swiftly changing all the time. It's actually, in my opinion, kind of removing FOMO in a real way, because everything could change. A ton of revenue can be gained, a ton of revenue can be lost and churned. What do you see as the impacts for the actual venture capital role with kind of all these things that are happening around AI?
I mean, I would honestly say that the relationship piece starts to matter even more. I think that you're going to have the identification of companies become ubiquitous. Like everybody will have access to at least the public sources of information. Everybody will be able to identify these companies. But why are you going to win? If this is truly an elite entrepreneur building what could be an elite company, it's kind of like, how are you going to show up to that entrepreneur and earn your place at the table? It's hard for me to imagine a world where there's a digital venture marketplace. An entrepreneur says, I want to raise X amount of money. And on the other side, there's a series of bids. And they're going to make their decision based on what's the highest bid. Like, I just think that the human elements of venture are going to be consistent. But I do think the identification of companies, I think that piece is already being very automated. I think, some of these companies are probably being called on by dozens of different associates from different funds. And so, when you see people winning, that's a big signal for us. Obviously, at the early stage, we're paying a ton of attention to, and this would probably be like at pre-seed and seed. How are the companies developing operationally? What do the downstream investors look like into those businesses? So there's a lot of stuff that I think we're ultimately tracking, but I think there's just a human element of venture that's always going to be at play because, as of now, it's still people that are building companies. AI is obviously a much bigger part of what's happening in every industry, but you still need great people to build great companies.
You spoke briefly to the maybe opening of the IPO markets, and we've seen M&A finally heat up with AI talent acquisitions. Curious, with your relationships with your LPs, what the conversations are like around liquidity, or where you're coming to terms there, if there's any agreements on how you, I don't know, timelines or how you should be approaching it.
Everybody wants more of it. I do think it is something that as an asset class, GPs do need to be thoughtful about it, and they do need to be thoughtful if there's not M&A and there's not IPO that can generate liquidity in your portfolio. If you're coming back to market with a new fund, a lot of LPs are in challenged positions, depending on what their program looks like, that they do need some DPI to be able to support new strategies. So, that's why for us, like what we're doing in the GP-led market right now, which is a ton of education, a ton of content, a ton of resources to provide to GPs really how to think about things, whether those are continuation vehicles, if you're registered, how to think about tender offers, how to think about strip sales, things that you could be doing from a portfolio management perspective to generate DPI and to generate distributions for your LPs. I do think it's an existential thing for a lot of people in the venture asset class, and something that, outside of building the portfolio upfront, something you need to be thoughtful about building the portfolio at the tail, or exiting the portfolio at the tail end.
Anthony, you all have been both at Greenspring and now StepStone, really leaders of the allocator kind of industry. Where do you see the next 10 years for your platform going?
I mean, at the end of the day, North Star for us is to be the most valuable lifecycle partner that we can be to, the entrepreneurs, to the GPs, and to our LPs. I think we believe capital gets more and more commoditized over time. We wake up every day and ask ourselves, how can we be a better partner across, that spectrum of people that we're working with? Investing into things like our portfolio impact program, at the end of the day, like, our manager's success is our success, and they're really sitting at the center of our universe. So, everything that we're doing is really oriented around how to make our GP relationships and our portfolio companies, whether they're direct or indirect, more successful. So I don't think that will ever change. I think in different times, for some of our funds, we're going to optimize the strategy based on where we think things are more interesting from an opportunity set perspective. So, we think the US is a great place to be investing in innovation right now. A lot of the stuff that we were describing around, what's happening in some of the more, some of the more interesting categories of deep tech, like that's great exposure. In many ways, feels like we're in what's a technology renaissance here in the US. So, we're going to continue to lean into that. We're going to be thoughtful about how we execute in the secondary markets, because we think that they're interesting buying opportunities, but it's also going to be a really important part of the venture asset class that looks probably different than how venture looked in the prior decade or two. So, I think the reality is we will see very scaled companies like Stripe, like Databricks, like OpenAI. These companies are doing private IPOs today. And I think the reality is you will have early stage venture funds that may be invested into the next generation of these companies, and the entirety of their hold may ultimately be in the private market. They may never see the public market or an M&A event. So, there's going to be more off ramps, certainly. And we think it's already happening today, but in the next decade, I think that'll be a huge part of the asset class.
Man, thanks so much for being here, and generally just being a super open partner to everybody in the industry, because it's so interesting always to read everything you're publishing, and now we're getting to hear what you have to say. Thanks.
Well, it's an honor to have been invited here. From humble beginnings in West Virginia, and we kind of keep a healthy paranoia. I think we've enjoyed some historical success, but we continue to make significant investments into our team and into our technology platform to better serve our LPs, our portfolio companies, and GPs, in the future too. So, we know that the competition will always come, and how we continue to innovate ourselves is something that, we wake up really energized around every single day.
Thanks, Anthony. Really appreciate you.
All right. Thanks, Ernest. Thanks, Alexa.
See you later, allocator.
After Portfolio Tile, investing with a smile.